Okay, let's have a look at what the market's doing, because obviously we've got people all over Australia, and we need to really have a submersion and see what the hell is going on. So let's go through the CoreLogic report. So obviously home value index rate of decline eases despite a 1% fall in January. So further 1% in January is a slight improvement on the 1.1% decline recorded in December, and the smallest month-on-month decline since June last year. The reduction in the rate of decline was evident across most capital cities except for Adelaide and Perth. Adelaide was negative 0.8 and Perth was negative 0.3, where the housing values have held firmer since interest rates began rising in May. Okay, some momentum has left the housing market downturn, which is good news. Negative 3.2 over the rolling quarter. National housing values are still falling quite rapidly compared to previous downturns. Every capital city posted a decline in dwelling values through the month. Hobart minus 1.7, Brisbane minus 1.4, and Perth minus 0.3, Darwin 0.1. So Sydney's medium dwelling value dropped below 1 million for the first time since March 2021, minus 1.2 in January. On December's negative 1.4 decline. Most noticeable value falls can be seen across premium end of town, countries, most expensive properties, recent upswing, as well as current downturn. So what goes up must come down. So obviously the top end of the market has been showing the biggest. So obviously what goes up must come down, and the biggest upswing properties and areas are showing the biggest downturn. So I think that's clear and obvious. Through January, regional housing values continued to record a milder rate of decline than each of their capital city counterparts, a trend seen through most of our downturn to date. Milder decline comes after a substantial stronger upswing. Housing values surged 41.6 higher through the upswing compared to a 25.5 rise in values across the combined capital cities. Regional index is now down negative 7.4%, while capital city values are now negative 9.6% below their April peak. Regional housing values are holding up better than capital city markets, clear and obvious. With more Australians willing to base themselves outside of the capital cities and remote working remaining a viable option across some sectors of the labour force, it's unlikely we'll see a mass exodus from regional markets. So big positive for regional markets. Their property values are probably going to hold a lot better due to those reasons. January marked a new record for how much and how fast dwelling values have fallen in Australia. Based on the monthly index, the national HVI is down negative 8.9 since peaking in April last year, making it the largest and fastest decline in values since at least 1980, when CoreLogic records began. So far, Brisbane, they have just, and I know why, obviously you're in a tough time there, Julie, is of course Brisbane has come down minus 10.8%, and they were still showing positives in December, so it's insane. Hobart minus 10, Sydney home values down 13.8%, and not far from surpassing the 2017-19 drop of 14.9 to set new decline records. So we've had a shift in the market, obviously in certain parts of the country. Record decline in home values follow a record upswing. So despite the recent sharp drop in values, every capital city and the rest of the state region is still recording home values above pre-pandemic levels, although Melbourne index would only need to fall a further negative 0.4% before equaling the March 2020 reading. So that's a positive. Obviously, we're still East Coast and most states and territories are still above pre-pandemic levels. So that is obviously a positive. So just having a look at the prices, Sydney dropped 1.1 for the month, negative 3.9 for the quarter, and they're at 13.8 annually. Melbourne, 1.1 drop, negative 3.1 for the quarter, and minus 9.3 for the 12 months. Brisbane, 1.4 for the month, 4.8 for the quarter, and they're showing a negative 4.7 for the past 12 months. Adelaide, 0.1 negative, 1.5 negative for the quarter, and 6.9 growth for the year. So they're still showing a growth for the year. Perth, as I mentioned, 0.3 negative, quarter nearly flat line, minus 0.1%, and we're still showing a growth of 2.7% annually. So combined capital cities, minus 1.1 for the month, minus 3.3 for the quarter, and minus 8.7 for the 12 months. Combined regional, negative 0.8, negative 2.6, and negative 2.3. So combined, we have got nationally 1% down on the month, negative 3.2% down on the quarter, and negative 7.2% down nationally. So obviously those are our national figures. Let's have a look at stock. Okay, so low advertised supply remains a feature of the housing market through January. Time of the year, new capital city listings added to the market over the 4 weeks ending January 29 were minus 22.2% lower than over the same period last year, and minus 24.5% below the previous 5-year average. Every capital city recorded a below average number of new listings through January, reflecting an ongoing reluctance from prospective vendors to test the market. Housing demand has also fallen away. Capital city dwelling sales over the past 3 months were estimated to be negative 20.9.4, lower relative to the same period in 2022, and minus 11.5 below the previous 5-year average. So not only are the prices, stock levels down, but sales are down tremendously as well. Sydney, minus 40.6% down in sales. Melbourne, minus 39.8% down in sales. And Brisbane, minus 36.5% down in sales. Adelaide was only minus 2.8 down in sales, and Perth only minus 3.6 actually. So that's interesting. There is a strong relationship between consumer attitudes and the number of home sales, with sentiment remaining around recessionary lows. It's harder for consumers to make high commitment decisions such as buying or selling a home. Until Australians have a higher level of confidence with regard to their household finances and the outlook of the economy, it's likely they will continue to delay major decisions. All right, so just to kind of give you a bit of a wrap up of that particular scenario, it's quite easy to understand that people are not bringing their properties to the market because of the fear of loss, the fear of the market conditions. We also have a tremendous shortage of property, so a lot of them have nowhere to go. But we've already we've got scripts for that. But until the market stabilizes, we're going to be scratching around for less sales in most states and territories until the consumers get a bit more confidence to put their properties on the market and make their necessary moves. So as you can see, one thing feeds the next, and that's what's causing not only the shortage of listings, but the down, the less sales, which on the East Coast is horrific. Nearly, between 1/3 and 40% down in sales. I'm sure for those Perthians who we have, if that happened, we wouldn't be very happy. So we're very fortunate that that hasn't quite hit us. And let's read some further. Okay, so the monthly pace of rental growth picked up a little in January, with national rents up 0.7 compared to 0.6 rise in December, but still well below the peak monthly rental growth rate from May 2020, which was 1%. The rise in pace of rental growth was centered in the capital city markets, where monthly rental growth lifted from 0.6 to 0.8 in January. From December to January. Growth in rents across the combined rest of state areas reduced from 0.6 in December to 0.4 in January. Over the rolling quarter, national rents rose 2.1%, which was higher than quarter four, which was only 2%, but down from the recent high of 3.2% over the 3 months ending March 2021. The rate of growth in house rents is generally easing in most regions, reflecting a transition of demand towards more affordable, higher density type rental stock. It's likely a resurgence in overseas student numbers. This is interesting. I want you to pay attention. It's likely the resurgence in overseas student numbers will add a rental demand over the coming months, especially in light of the recent policy announcement in China, where academic degrees and diplomas awarded from online studies will no longer be recognized. That's a massive thing. So I'll say that again. There was an announcement in China where academic degrees and diplomas awarded from online studies will no longer be recognized, which means that a lot of the online learners in China will now be forced to come to Australia to do their degrees and diplomas. With overseas student numbers surging, it is likely inner city rental precincts and suburbs close to universities, especially those in Melbourne and Sydney, we'll see a further tightening in vacancies. Gross rental yields have continued to trend higher, rising from historic lows of 3.21 in February to 3.85 in January. The 64 basis point recovery over the past 11 months has seen gross yields rise above the levels recorded over the onset of COVID. So we are seeing an improved return on investment with properties, but it's still below 4%, which is quite low. All right, let's have a look at the housing outlook. The trajectory of housing values remains intrinsically linked with the path of the interest rates, which is obvious. The good news is the cash rate may be approaching a ceiling as speculation amounts that inflation has moved through a peak at the end of last year. That's what I said. However, there's likely to be at least one more rate hike, potentially two, that will continue to erode borrowing capacity and exert additional downwards pressure on housing. Once interest rates move through a peak, it's likely that housing values will stabilize. Some downside risk for the large number of fixed rate mortgages due to expire later this year. Around 2/3 of the fixed rate home loans, which comprise substantially larger portions of the loan book than historically normal, will expire in 2023, with many moving from interest rates around 2% to closer to 6%. It's likely mortgage arrears will rise from last year's record lows, but the risk of a material increase in mortgage arrears or defaults should be minimized as long as labor markets remain tight. So there's another saving grace. There's another safety net for our property market, is the labor market is tight as, yeah, you finished the statement. Advertised stock levels will be a key metric to keep an eye on. Such low advertised supply has arguably helped to keep a lid on value declines, but a lift in supply without commensurate rise in demand could prolong the downturn, with overseas migration accelerating, especially among foreign students. That's the outlook. Let's just bring it back to reality, because obviously 75% of our members are in Perth. Perth property market is holding steady, resilient and stable compared to the East Coast, seeing lots of correction, excellent position to weather future rate rises with growth population. Listings at 7,104. That is, again, tighter than a Badger's butt. This is up from 12-year low of 6,931 reported last month, but 10% lower than levels seen a year ago. Decline 13% in the second half 2022, and new listings January down 24%. So frightful starvation of stock in Perth. However, if new listings remain low, we'll see the number of properties for sale continue to decline and the housing shortage worsen. While we're expecting some relief as building completions increased late last year, HIA data showed new home sales in the last quarter of 2022 were 30.9% lower than the same time 2022, suggesting the supply of new housing will decline because they cannot bloody get them built. This will further accelerate the housing shortage. Time on market, medium house price is 27 days. I think that's incredibly low, and it's worse than that. Obviously, that's the median. Perth median rent price, 520 per week. This is interesting. 20% higher than 3 months ago and 70% higher than January. Sorry, $70. $20 higher than 3 months ago and $70 higher than in January. That's insane. Rents have gone up in $20 in the last 3 months and 70 since January 2022. Okay, listings for rent. Only 1,905 listings for rent. A significant decrease. So 18% lower than the same time last year. Okay. Median of 15 days. So I think it's fair to say that, and we have been saying this for at least, nearly a year. Obviously, the market has been running at parallel. It's been a parallel or a dual market, they call it. It's been a dual market with the East Coast. But I think what is interesting, and I want to mention this, is middle of last year's the dual market was Sydney, Melbourne, which was facing declines and downturn quite sharply. Now, Brisbane and Hobart have now added to that side of the equation. And the only ones on the opposite side of the dual market is Adelaide and Perth. So, okay, so read into that as you wish, but I can't believe the declines in Sydney and Melbourne, and I can't believe how Perth and Adelaide are still performing so well. Look, it can be explained in a lot of ways, but it is something to take note of and just be aware of. I think that the saving grace for Perth and Adelaide is we didn't see massive early growth, and I think over the 12-month over the boom, I think we only saw over a 12-month period about a 5.7% growth in Perth, and I think we all said, like, how can that be? We're selling properties for 100 grand more than what we were. But I think it was obviously taken over the whole urban sprawl, and certainly obviously has helped us be resilient from the downturn, and obviously stock levels. So those are obviously the biggest explainers. So Anita's just handed me something. So the properties for sale now in Perth are only 6,993, and I've been told, I've never seen them that low. I think 7,000 was the lowest that we've ever seen. Has anyone seen lower than 6,993 properties? I don't think we have. I think that is crisis point. Perth rentals are 1,851. So that's the most recent. The other one I read was January. So that's pretty. I know that was the 1st of February. This is the 5th of February. So that's how quick it's changed. So we have sold. We've gone from 7,100 to 6,993 properties. So it's further dropping.